Have you ever been there? You're staring at a stock chart, you've drawn the lines, you feel like you've finally cracked the code, only to end up more confused and, frankly, poorer than when you started. It's a super common and painful frustration. Well, today we're going to pull back the curtain on one of the most popular and most misunderstood tools in the entire trading world, the moving average. We are going to break down what it really is, how you're supposed to use it, and maybe most importantly, why it might be failing you right now. So let's get into it. So here's our game plan. First, we're going to talk about the beginner's trap, that feeling of being totally stuck. Then we'll decode what a moving average actually is with a really simple analogy. After that, we'll get into the famous golden cross and death cross, and, crucially, when those signals can flat out lie to you. From there, we'll learn how to build a real professional grade system around them. And finally, we'll wrap up with the psychological superpower you need to actually make all of this work. All right, section 1, the beginner's trap. Let's start right here, with that feeling of being completely overwhelmed. And look, this has nothing to do with being smart or not. It's about a very real psychological hurdle that trips up so many new investors when they first start looking at charts.
I mean, this is the big question, isn't it? You did the homework, you watched the videos, you added the 50-day and the 200-day moving averages, you waited patiently for those lines to cross, and then the market does the exact opposite of what you thought it would. If that sounds familiar, you are definitely not alone. That confusion, that feeling of being betrayed by the very tools that were supposed to help, that's practically a rite of passage.
Wow, this quote just perfectly captures that paralysis, doesn't it? You own a stock, it starts to drop, and suddenly every option feels like a trap. If I sell it, it's going to rocket up tomorrow. If I hold on, it could go to zero. If I buy more, am I just throwing good money after bad? You see, this frozen feeling doesn't come from a lack of information. It comes from having just enough to be dangerous, but not having the system and the rules you need to have real conviction.
You know, there's actually a name for this whole thing, the Dunning-Kruger effect. It's especially potent in investing. Think about it. It's so easy to get lucky at first. Maybe you start in a roaring bull market where everything's going up. You use a simple moving average cross, buy a stock, and boom, it works. Your brain goes, hey, I'm a genius. This is easy. But you might be confusing skill with just a rising tide that's lifting all the boats. And that overconfidence makes you think the tool is magic right before the market changes and you learn all the painful ways it can fail.
Okay, so on to section 2, decoding the moving average. To get past that beginner's trap, we have to go back to square one. We're going to build your understanding from the ground up so you know exactly what this tool is, what it does, and just as important, what it doesn't do. And to really get this, let's forget about stocks and charts for just a minute. We're going back to school. Because the good old grade point average, the GPA, is a perfect analogy for how a moving average actually works. It's all about how you measure performance over time. So, imagine a student starts the semester on fire, 2 A's right out of the gates. But then, things fall apart. They get 2 F's on the next 2 tests. Now, a traditional average, like a final GPA, treats all 4 of those grades exactly the same. You add them all up, divide by 4, and you get a C. Sure, that tells you their overall performance, but it totally misses the most important part of the story, the recent dramatic downturn. It doesn't tell you what's happening right now. But now, let's apply a moving average. Let's say we only care about the last 2 scores. Well, after those 2 F's, the student's moving average is an F. And that is the light bulb moment. The moving average brings proximity into it. It's all about recent performance. It answers that critical question, what have you done for me lately? Because in the market, we usually care a whole lot more about what a stock did in the last 20 days than what it did 20 years ago. That's its power. And this leads us to a really crucial rule of thumb. The shorter your average, say a 10-day average instead of a 200-day, the faster it's going to change. A short-term average is like a little sports car. It's zippy, it's nimble, and it reacts to every single little turn in the road. A long-term average, on the other hand, is like a massive cargo ship. It takes forever to turn, but it shows you the powerful underlying current. One reacts to noise, the other shows you the real trend. Yeah, this slide really lays out that trade-off perfectly. It's the classic tortoise and the hare. The fast-moving average is the hare. It zips all over the place, hugging the price really closely. It gives you early signals, for sure, but it also gives you a ton of false alarms that can shake you out of a perfectly good trade. The slow average? That's the tortoise. It's way smoother, much steadier, and way better for seeing the big long-term trend. The catch is, it's always late to the party when that big trend finally changes. So neither one is better. They just have different jobs.
Okay, section 3, golden crosses, death crosses. Now that we've got the basics down cold, let's get into the stuff that makes the headlines. We're going to take what we know about fast and slow averages and turn it into a clear visual system for reading the direction of a chart. Now, you can technically use any period you want, but the pros tend to focus on a few key ones. The 20-period average is popular because it's roughly 1 month of trading. The 50-period gives you about a quarterly view, and then there's the big one, the 200-period moving average. That represents the long-term yearly trend. For a lot of big institutions and funds, if a stock or the whole market is trading below its 200-day average, that's a huge red flag. It's time to play defense. So first up, let's look at the bullish setup. The golden cross is that famous signal that gets everyone excited. Technically, it happens when a faster moving average, like the 50-day, crosses above a slower one, like the 200-day. The idea is that recent momentum is starting to win, shifting the long-term trend upwards. But a simple cross is not the whole story. For real confirmation, we want to see a very specific, beautiful alignment. This right here, this is a textbook healthy uptrend. The easiest way to think about it is like building a house. At the very bottom, you've got your slow average, the 200-day. That's your solid long-term foundation. On top of that, you have your fast average, which is like the floor, providing immediate support. And finally, you have the price itself, living happily on top of that whole structure. When you see all three stacked in this order, price, fast, then slow, that's a really powerful visual that things are strong. And now for the flip side, the bearish setup. The death cross has that ominous name for a reason. It often shows up before some pretty big market downturns. This happens when the fast-moving average crosses below the slow average. It's a warning shot that short-term momentum has broken down, and it's signaling a potential trend change to the downside. And just like the bullish setup, the strongest confirmation of a downtrend is this exact reverse stacking order. It's like an upside-down house. Now, the slow-moving average is at the top, acting like a heavy ceiling of resistance. Below that, the fast average is more immediate resistance. And at the very bottom, trapped under all that weight, is the price. When you see this alignment, it's a super clear sign that the bears are in total control. On to section 4, when your averages lie. Look, if trading were as simple as buy the golden cross, sell the death cross, we'd all be rich. So this is probably the most important part of this whole explainer, understanding the number one environment where these signals will not just fail you, but will actively chew up your account. This right here is the number one account killer for new traders. It's called the whipsaw. It happens in a choppy, sideways market where there's no clear trend at all. In this mess, the averages will just cross back and forth, over and over. You get a golden cross, you buy in, feeling great. A few days later, boom, it flips to a death cross. You panic and sell for a loss. Then it crosses back up. This cycle will just chop you to pieces with small losses and completely wreck your confidence. And here's the key. Moving averages are trend-following tools. They are worthless if there is no trend to follow. This quote really drives the point home. It's a huge warning against being too simplistic. A simple rule like, hey, if the price is above the line, I'm buying. If it's below, I'm selling. Well, that's a deeply flawed strategy. It completely ignores the most important question you have to ask first. What's the market context? Is there even a trend? Or are we just stuck in a range? A moving average is just one tool in your toolbox. It is not a complete trading system by itself. So section 5, building your analysis system. If a moving average isn't a system on its own, then how do we use it the right way? Well, we need to put it inside a larger, more professional process. We use it as one part of the machine, not the whole engine. So let's build that framework right now. A really logical next step is to add another tool, like the MACD. The best way to think of the MACD is like a health check for your trend. It's literally built for moving averages, but its job is to measure momentum. It doesn't just tell you which way the trend is going, it tells you how fast it's moving. Think of a car. The price tells you it's moving forward, but the MACD tells you if the driver is flooring the accelerator or if their foot is starting to come off the gas. It's a fantastic confirming indicator. And this right here, this is the top-down routine that pros use. They don't just wake up and hunt for a random stock. They start with this 3-step process. Step 1, what's the broad market doing? Is the S&P 500 in a healthy uptrend? Step 2, okay, which sectors are leading the charge? Is money flowing into tech, or energy, or healthcare? You find the strongest group. Then, and only then, do you drill down to find an individual stock in that strong sector that has a perfect bullish setup. This whole process just makes sure you're always swimming with the current, not fighting it. And that brings us to our final section, patience, probabilities, and profits. We've covered the technical tools, we've covered the professional system. But you know what? None of it means a thing without this last, most important piece of the puzzle. This is the glue that holds everything together, mastering your own psychology.
This fishing analogy is just brilliant. It speaks to our deep-seated need for action. So many of us feel like we have to be doing something all the time. We get bored. We sell a great stock that's just moving sideways, building energy for its next big run, just because we're impatient. This constant need for a moving bait is so destructive. You have to remember that sometimes the most profitable move you can make is no move at all.
And this gets us to the real goal of all this. Technical analysis, these charts, they are not a crystal ball. You're not trying to predict the future. The true purpose is to identify situations where the odds are stacked in your favor. Think of yourself as a pro baseball player. Your job isn't to swing at every single pitch. Your job is to have the discipline to let the bad pitches go by and just wait patiently for that one perfect pitch right in your sweet spot. The hard part isn't learning the charts, it's learning how to sit on your hands and wait.
We'll end with this heavy dose of reality from the investing legend Charlie Munger. The second you think you've figured out the market, the moment you feel like this is easy, is the exact moment you are at the greatest risk of losing a lot of money. That's the Dunning-Kruger effect coming back to bite you. Real, lasting success in this game requires humility, a commitment to your process, and a deep respect for just how difficult it really is. And that right there is the real secret.